have loving and nurturing regulator. So when do I go to Kenya? All right. So does it work? Yes. Paf. So we believe that when people protect people, things are going better for them and in a more fair way. I represent TongJuBao and P2P Protect, but it's the same company. I first launched in China. So TongJuBao means something like protecting each other between friends. And yes, there are different, no, I cannot move, right? Yes, yes I can. Yes, I can. So this way I can look at my slide as well. There is different protection model, right? The traditional one, the one that we all know, the traditional insurance is a model where you have customer transferring risk to a central actor, which is the insurance company. We all know the model. It's the one which is kind of running the insurance world today. We all know as well mutual insurance. I think that in many countries and possibly in many of your market as well, there are some form of mutual insurance. The principle of mutual insurance is within the same framework of transferring the risk to a central actor to say that instead of being owned by private shareholder, these central actors will be owned by his customer, so that there is a way of balance so that the profit made by the insurers is shared between all his customers. Fine. What's appearing more recently is a range of actors who, one way or the other, can refer to peer-to-peer insurance. So what is peer-to-peer insurance? To give it the definitions I gave, which is the more pure way of peer-to-peer insurance in my eyes, this is this. You have a group of people who enter into a commitment to protect each other. So they protect each other in the form of a contract, and, well, the contract is kind of replacing the existence of a central actor. So it's decentralized in a way. No, you can hear? Yes, good. Maybe if I don't use a microphone, you still hear, right? Anyway, translate will not. Oh, yes, so let's go. Okay, microphone. So in this model, you don't have an insurance in the middle. You still need to have usually a service company to provide a platform for the users to reach each other and also to help with the risk modeling, which remains a technically complex matter. This is a model we're running in China. In Europe, there is a bit more of the peer-to-peer brokerage type of models, which is doing peer-to-peer at the recruitment level in the recruitment channels, but still has insurance product manufacturers on the back, insurance company. And you also have something which is a bit more hybrid, which I could call mutual aid platforms, which is a model which has been developed in China with members being related to a central entity, but the central entity not being an insurer, which is guaranteeing the risk, but which is pooling the resources to be able to give back to every member based on the amount which is pooled. I brought together two slides here to give a Western view of peer-to-peer insurance actor and a Chinese view of the peer-to-peer insurance mutual aid models. So in the Western part, you see that there start to be a lot of actors pretending to play in this field. Even so, some of them, like Guevara, has disappeared. And sometimes, well, one from China was mentioned here because it was us and we were more visible because we had a website which was bilingual and translated in English as well, contrary to the other guy. On the Chinese one, however, what is a surprise is that you have a few actors which in a few years have been reaching a real significant scale. You have two actors here, one with 10 million users, the other with 17 million users. We are really speaking about model which succeeded scaling up. And of course, ourselves as well, a few others. So why does it work in China? And what what does it bring? The first thing is that insurance penetration is low in China. We are not speaking about a mature market, but an emerging market. And in particular, in the low-income and rural segments, you may have 800 million people in China who don't have insurance at all or don't have any decent insurance at least. And facing this, you don't have adequately priced insurance product, traditional insurance product, for the majority of the populations to have basic support against things such as critical illness, such as cancer, etc., terminal disease, for which they have serious worries. The third point is a point on which my own company is a bit more positioned, is that you also have many social risks which are not covered by traditional insurance. For example, well, divorce is a financial risk for both spouses. And it could be treated as a risk of frequency, but usually no insurance is doing it. So that's one of the things that we tested covering. But also other things such as child trafficking, migrant family precarity. And then you have the universal reality. It's tough for us because we all have some degrees of insurance background, but insurance is often perceived as a bad answer to a real issue. We hear things such as, well, they take your money and they keep it. Of course, it's unfair, but, well, you hear a lot about it. And this negative perception tends to be exacerbated for the millennial generation. So how do we try to address this? We try to address this by returning everything to the user. And the first things we try to return is money, with a principle which is that the risk money is your money. So it means that we have separately a small amount of fee which cover our operating cost, but the money intended to cover the risk is isolated, and 100% of it go back to the community. There are accidents, indemnity are paid. If there were no accident at all the amount will be returned to every member. And this is a principle which is very strong and give confidence in the user, in the fairness of the system. And in practice, it adjusts the price of the protections to the reality of the risk suffered one given year. You are all insurers, so I will acknowledge that there is one limit to this. It works pretty well for risk of frequency. You are not going to cover natural disaster with this kind of principle, because instead of accumulating the excess as reserve during 20 years to face the tsunami, the earthquake, which happened after on the year 21, you redistribute it every year. So it works for risk of frequency. You have to know what the model is good for. But it pleased the customer pretty much. Next slide. Up. No, my finger is not working anymore. It's cut. Up. Yes. So I was saying, well, you see where I come from. I'm sorry, next time I will try to prepare one slide with less Chinese eyes on it. But the principle is back to the user. So I've told you about returning the money to the user. We try to return information and to return power to the user as well. Return information, what does it mean? It means that we all know the experience of going to an insurance agent. You sign on a one-page summary. There are 40 pages behind. Nobody ever read it. So you don't know what's the real protections given by your insurance. And 1 year, 2 years, 3 years, you have no accident. On year number 5, you have an accident, and you discover that year's what may be or may not be the exclusions which will prevent you from having your indemnity. But you discover it too late. So we thought that need to be addressed. And we do it by giving to our members every month a dashboard which is saying, in your community, you have 5,000 persons, 150 claims this month, 120 accepted, 30 rejected. But the 30 rejected, you have 10 rejected for reason category A, 8 reason category B, etc. So everyone learn month after month what are the clauses for exclusions. And there is two main benefits for this. The first one is when someone have an accident, he know already if his case is excluded or not. So he doesn't have the frustration of discovering too late the information. The second benefit we do is to use it to return power. Because people every month see what is not accepted, they can react to that. And they can come back and say, hey, but we would like to change this rule for the future. And they can trigger a vote online to change some of the features or some of the exclusions. And the beauty of it is that they are extremely reasonable when they do those votes, because they are not only protected, they are also the people who put the money to cover everyone and who will get the money back if there is less risk. So the last thing they want is to have to open the door to fraudster, to abuse of the system. So the behavior is pretty good. And the impact on user recognition is pretty good as well. Well, this is a bit too small to be seen from the back of the room, but basically acquisition is still a struggle because it's a new model, but the retention is over 90%, and that's pretty good. And the virality, well, virality is usually not even a word you pronounce a lot in most of insurance models. So we have a virality, and it's increasing over the months, because when people make the experience of this is working, and those guys not only tell you they will give you back money, but they really do it at the end of the year, then they want to talk about it to their friends. When they just subscribe, no. Who knows what those guys do? But at the end of the year, they do it. So as said, for us particularly, we did some fancy product, divorce, child trafficking. Well, I shall not call that fancy, but that's unusual. We've moved recently from China to France to test the model in Europe, and we are working in launching product related to over-indebtedness or product related to solidarity against terrorism. This being said, mostly to say that don't pay so much attention to the product I mentioned here. The things to catch is we try to address insurance of social risk or societal risk, which is new. But those issues will not be the same in every country. So if you know about an African country where there is zero divorce, you don't need to launch divorce protection, right? But you may have other things which are more relevant in your respective market. And that's my last slide, because I think I ran out of time. Just to say that innovators usually have a long road to regulatory safety, and regulators, of course, are held responsible for the stability of the financial system, while innovation by essence is movement, so it's not tested. But we do hope that regulators' missions is also to facilitate and nurture innovations. I'm feeling very relieved to listen at you. And as entrepreneurs, innovators, we hope you do think the same, because innovation is frail. There is so many ways to kill it before it goes live, and you can do it without even knowing it. So I had a couple of regulator stories on how it can give deskies, but basically, my point is not that regulators want to kill innovations. Usually they don't. But the fear of the regulators in everyone else in the market, in our potential partners, in our potential fund provider, is such that if there is no sign which is giving clarity about the regulator's intentions, that could kill a lot of innovation process on the way. So we need loving and nurturing regulators. Thank you.